Hey everyone, it's your boy. Welcome me back, just like Mace. I am so excited to be back right now talking about dividend stocks, what I love the most, and I have a really good video today. I'm going to talk about some breaking news because there are two dividend increases that I just received in my personal dividend stock portfolio. They were unexpected. Hey, any dividend increase these days is reasonably unexpected during this global pandemic and a overall wacky economy right now. But I'm talking about General Mills and also Philip Morris. I want to talk about my experience with those two stocks and what I think about these dividend increases. I also want to share with you today two stocks that I purchased recently. And I have a lot of insights. I've been thinking a lot recently about dividend investing, what it means for me, especially now that I'm working 7 days a week. I'm working really long hours. Things at my job have gotten very busy. And so that puts a lot in perspective, and it gets me thinking about dividend investing. I have a wealth of information I want to share in the video today. If you got the reference, by the way, to Mace, bonus points to you, OG Thug Life Investing. Drop a comment below if you know what I'm talking about. And please don't forget to hit the thumbs up, the like button. Let's get started, everyone, with an exciting video. All right, everyone. So I want to start with General Mills. General Mills. Man, I've got all the Cheerios. We got the Cheerios all over the place. Lots of them. Got to stock up on Cheerios. And I guess I am the perfect example here. 3 unopened boxes of Cheerios here. I am the perfect example of why General Mills is doing so well right now. It is so interesting that back when I was buying General Mills in 2018, I'll share a link to that video in the description below. So many people were skeptical of the company at the time. So many people were thinking, did they get in over their head with the Blue Buffalo acquisition? Did they pay too much? Are they taking on too much debt? A lot of dividend investors at the time were skeptical of the stock because they froze the dividend at that time. Check it out on the screen right now. I am proud to announce that General Mills just increased their dividend from 49 cents up to 51 cents. And so this is roughly 4% increase in their dividend. And this is something, again, that was unexpected. I totally did not expect this at all because when General Mills took on the Blue Buffalo acquisition, they made it very clear to shareholders that the dividend would be frozen. And honestly, at that time in 2018, I went in and I built a position, a full position in this company relatively quickly because I liked the acquisition. I saw that Blue Buffalo was a premium pet food company. And I see in our society right now how many people are becoming moms and dads of dogs, and they're taking it really seriously. Pets are a big thing. I don't have a pet right now, but maybe our family at some point will have a family dog. But I see from my colleagues, from my friends, how important pets are to the dynamic these days, and they're becoming even more important during this global pandemic. Everyone wants a best friend at home during these crazy times. Anyways, it's so interesting how quickly the cards have turned. So check it out on the screen right now. I have some statistics I want to share with General Mills. And so let's just look at this. When I first bought this thing, I bought this thing back in April of 2018 at $44.99. That's my first tranche anyways. And I built most of my position in 2018. I went aggressive from the beginning because I saw a good opportunity and I seized it while everyone else was skeptical. Starting dividend was 49 cents. And so when I bought the thing, I locked in a 4.36% dividend yield. And honestly, I expected that dividend yield to be my dividend yield in perpetuity because I believed the company that when they froze the dividend, it would be frozen for quite some time as they paid down debt from the Blue Buffalo acquisition. I would have never in my wildest dreams imagined that just 2 years later, 2.5 years later, that this company would be raising the dividend once again, how quickly the cards turn. And so I want to move on and talk about where it's at now. It's at $58.70 right now, so I'm up 30% capital gains, capital appreciation on my first tranche. And the current dividend per quarter is 51 cents. And so the current dividend on the current share price, the yield is 3.48%. Here's where it starts getting really interesting, and you'll see below I have some highlighted cells. So fiscal 2021, they are expecting a $3.57 EPS, earnings per share. Analysts are expecting this. Fiscal 2022, the analysts expect a $3.66 earnings per share. So what does this put the PE at? It puts the forward PE right now on the current share price of $58.70 for fiscal 2021 at 16.44, and it puts the forward 2022 PE, fiscal 2022, at a 16.04. I highlight that for a reason. I talk about ride or die stocks here quite a bit. I'm going to share with you in a minute that one of the stocks I recently added money to was Starbucks, and I've been laser focused on ride or die because these are the stocks that build up the core of my portfolio, and I really want the core to be more representative of my portfolio. I want it to carry more weight in my portfolio, so I've been adding to these ride or die positions. But sometimes when I get kind of laser focused, I kind of look over opportunities, if you will. And so I'm really excited that this dividend increase happened because it triggered me to look at General Mills. And what I realized is this is trading at a PE of 16, even at these increased share prices that are 30% higher than when I started buying in 2018. And that tells me, hey, in this market, a PE of 16 on a company like this that arguably will continue to do well. We'll get to that in a minute. But I think this, look, people will get back to normal. I think the pandemic is, maybe there will be a wave 2. I don't know. But as of now, things in my area, at least, are more or less getting back to normal, or at least they're starting to, some sense of normal. But I think consumers, they're going to be smart. They're going to be smart to stock up. And they're going to be smart to eat at home a little bit more, to be careful about what they put in their bodies, because no one wants to mess with their health. And so I would say that General Mills will probably continue to do well into the future. And so what I'm saying is getting in at a PE of 16 into something that presumably will continue to thrive. It's not about entry point. And sometimes I miss this kind of thing because I'm so focused on ride or die. Who knows? Maybe I'll put a little bit more money into General Mills. It doesn't look like a bad deal to me right here. It looks like it's a reasonable deal. Now, I want to share stats on the screen again. Check it out. And what you see here is something truly fabulous. My yield on cost on my first tranche, simple yield on cost, not counting reinvested dividends, is 4.53%. Here's another metric that I like to look at. It's called PE on cost. And what I do is I take my purchase price, but then I divide by the current earnings per share or the forecasted earnings per share. And so if I take my original tranche, first tranche of $44.99, I divide by the fiscal 2021 EPS of $3.57, I come out with a PE on cost for 2021 forward of a 12.6. I come out with a 2022 PE on cost of 12.29. Again, fiscal 2022. Now, the reason I'm sharing these statistics is it just shows the value that can be created. The value is evident in the dividend, but here, because the dividend, it had been frozen for a while and just now they're starting to increase it, the real value is even more apparent for this company in the PE ratio on cost. And what you see here is when, as a dividend investor, I buy when others are heading for the hills. I sense some value that other people just aren't sensing. And quite frankly, I get a little bit lucky because who knows where General Mills would have been today if it were not for the global pandemic. And I'm not trying to make light of a horrible situation, but what I'm just trying to say is there's this element of unpredictability. There's an element of just in the stock market, you don't know what the future holds. And it's so there certainly I can pat myself on the back saying I bought this thing when everyone else was heading for the hills. But did I envision the future? Did I know what was coming up around the corner that would potentially make this company so successful in 2020? No. But that's part of the game, and that's part of the dividend investing game. And what's so interesting here is it is just panned out awfully well for me, very, very well. And so it's exciting to see that lower PE ratio on cost, which should continue to go down over time. Now, obviously, my heart goes out to anyone who has been affected by this horrible pandemic in any way, whether it's health-wise or from a financial standpoint, if you will, from just a standpoint of loved ones or friends being affected. My heart goes out to you, and certainly I would have preferred that there's no pandemic at all and that General Mills wasn't doing quite as well as it is. But it just so happens that that's how the cards played out. And so I want to share on the screen with you right now some key takeaways, because there's a lot of takeaways from this particular situation. I think the first one is just sector changes are not predictable. Back in 2018, like I said, I knew I was buying some value, but would I have ever thought that CPG, consumer packaged goods, food companies would be back in style? No, I did not think that. And so there's that element of unpredictability, that element of luck I was just referencing. And do I think the trend will last? I think it will. I think the trend will last because consumers are going to be changed. I think we will get back to some sense of normal, but consumers in some ways will be changed. And I'll tell you what else is changing here. From what I understand, more and more people are getting pets. More and more people are feeding their pets nice quality pet food like Blue Buffalo. Why are they doing that? They're stuck at home. I think a lot of people are starting to realize that if this happens again, if there's a second wave, if something goes down, they don't want to be alone at home. They want a best friend. And so I think that dynamic as well plays into General Mills. And looking at this from a very positive way, the way I like to look at it is bless this company. God bless the General Mills company, because they are a solution in very trying times. There are trying times right now, and thankfully they are providing the food and the nourishment that people need. And thankfully they are providing the pet food that all of the pet parents need to be buying for their dogs and for their pets. And so good on you, General Mills, for rising to the occasion. So I want to share some more stuff. Check it out right now. We talked about this. Buying great companies when they're out of favor is a winning strategy. I like looking at this case study because I wouldn't say recently I'm making mistakes, because I'm always buying stocks. But I have to remind myself I'm not buying value right now. I'm building my stream of income brick by brick by brick. Buying Starbucks at $83 is not a value. It's when I was buying it way back in March, I was getting great value earlier this year. But yeah, $83 right now in September of 2020, I'm not getting good value. And it kind of, looking at these kind of case studies, you may want to do it at home as well, because it's a refresher and it helps tell you what you should be doing. At least that's what it's doing for me. And what I'm seeing here is, Ian, I probably ought to be careful on the tranches I'm buying right now, because they are overvalued. And I see by looking back in history, Ian, when have you done well? When have you made the most money? You'll see this evident in the Philip Morris example as well, but it's when I buy great companies that I want to hold forever at value. Now, that's not always possible because there's not a lot of value now, but I have to remind myself of that. That's part of that perspective that's so important. And I got to save some cash for the next dip. What else have I learned out of all of this? Check it out. I have learned that the stock market may not be as overvalued as it seems. And so let me explain that. And so this contradicts what I just said, but investing in the stock market, it is a world of paradoxes. And so the Q1 results were even better than analysts' fiscal Q1 for General Mills, fiscal Q1 2021. Revenue came in at $4.40. Analysts were expecting $4.20. EPS came in at $1. Analysts were expecting 87 cents. So analysts are not stupid. They are reasonably smart. They are already forecasting for exceptional growth at this company. And the fact of the matter is that if these guys beat the analysts' expectations by this much, what's happening here is the stock market may be more more smarter in some ways than the analysts. And so a lot of people think now, oh, the market's overvalued. Oh, the market's gone up too much. Look at how the market is valued versus the forecasted PEs. What I'm trying to say is a lot of these forecasted PEs, they may just be flat out wrong. And I see it here at General Mills crushing the analysts' expectations that were probably already pretty lofty. And I see it at StarBucks and real world data when I'm just out and about and things seem really busy. Everyone is out and about doing their thing. And so that's something we have to remind ourselves as well. And that's why I do keep buying stocks now. Now I have to remind myself to buy them cautiously because the market's gone up a lot. But I am buying them for that very reason, because I think the numbers may come in even better than people think. So that is General Mills case study. I want to take a moment now and move into another stock, a sin stock, a thug life stock, if you will. Philip Morris. So check it out on the screen right now. Now, this dividend increase wasn't quite as unexpected as General Mills because Philip Morris raises the dividend every year. And honestly, it wasn't that good of a dividend increase. It was only 2% or something, 2.6%. That being said, I need to count my blessings. Any kind of dividend increase in such unprecedented times is something that is breaking news. It is something that is great news. And quite frankly, this is just another takeaway from the video, is this is why dividend investing is so wonderful. When one invests in world-class companies, great companies, they can raise the dividend even in the toughest of times. And we're seeing that right now with Philip Morris. Now, again, though 2.6%, is that something to get so excited about? Not necessarily, but that dividend increase triggered me to look deeper into Philip Morris for this video, and what came out of my analysis was truly astounding. It was something that I didn't even remember, and so that's what happens. So many years pass by, it's hard to remember all the details, and so let me share that on the screen with you right now. And so I started buying Philip Morris in April of 2009 at $38.29. Right now, it's at $76.35. And so I'm up 99% capital appreciation on that first tranche. Now, keep in mind, I have bought tranches much higher than this. I'll get to that in a minute. But first and foremost, it was nice just to have a reminder how far I've come since 2009. And again, a lot of people think with dividend investing, it's not possible to experience capital appreciation. It's only about the dividends. A lot of people think dividend investors are just losing money on capital appreciation, but are making it back on dividends. And that is not the case. I have a component of my portfolio that is a component of my gains that is capital appreciation, and I have another component of what I'm doing that's cash flow, that is dividends. Now, the dividends matter the most to me, but I surely have capital appreciation, and that's a fun part of dividend investing. Anyways, check out on the screen right now, and let's just look back in 2009. When I bought this thing, the starting yield was 5.64%. And the starting dividend per quarter was 54 cents. Dividend per year was $2.16. Let's fast forward, though, right below here to September. Right now, 2020, I'm up 99%, but check it out. The current dividend per year is $4.80, and that's at the new rate. The current dividend yield on this stock is 6.29%. And so I highlight that, and what's so interesting is the starting dividend yield for someone buying shares right now is higher than when Thug Life Ian started buying this thing back in 2009. That triggers an alert, if you will, and I'm like, hey, I'm out there buying StarBucks at PEs that are astronomical. I'm adding to Ride or Die. That's great and all, but Ian, are you missing something here? Are you missing something? Because there's value elsewhere. There is some value, and part of that value is right here in your good old Philip Morris, where it is trading at a starting yield, which is better than the starting yield I was buying at when I started buying the thing in 2009. Let's keep going. And so the 2020 EPS estimate is $5.08. 2021 is at $5.64. So the forward PE right now is a 15. The forward PE for 2021 is a 13. hey, that's not so bad again in this market. And so in the market right now, there's not a lot of value, but could Philip Morris be value? And so that's so interesting. Let's keep going. And so my simple yield on cost, not accounting reinvested dividends for my first tranche, how do I get that? Basically what I do is I take the current dividend per year, which is 480, and I divide by my first tranche purchase price of 38.29. It's a staggering 12.54%. I highlight that. That's Thug Life investing. This is why I'm a dividend investor, because not even counting reinvested dividends, I'm yielding over 12% on cost in this amazing company. Gets even better. Let's look at the value that I created simply by buying and holding this thing for so long. I don't think it will ever get back to my purchase price, and the reason being is this. It is the first tranche PE on cost. On estimated 2020 earnings, my PE on cost is a 7.54. 2021 is a 6.79. So just fabulous. Now, I want to share some key takeaways. And one of my key takeaways is, hey, yeah, I'm the man. I bought this thing at 38.29, but I also bought it at 117. And on the $117 tranche, I'm down 35%. What ended up happening there? So I owned another Thug Life company called Reynolds American. It did really well. I made a ton of money on it. One of my best performers of all time. Went all in on it in the early days. And it got acquired by another company called BTI. When it got acquired, there was some stock that I got in BTI, which I added to my position because I already owned the company. But also there was a cash component. When I got the cash component, I said, hey, I don't want to have less weighting in Thug Life stocks. Thug Life stocks, Sin stocks have been doing really well for me. And so at the time I took the cash, or a big chunk of it, and I rolled it over into PM at 117. And that was a high water mark time because there was a lot of M&A. And so a lot of the gains that I had on my Reynolds, I rolled into PM to lose 35% on them. And so what is so telling about this? What's telling about this is remain humble. I guess that's part of it. And also, this is a long game because, yeah, I'm up 99% on my first tranche, but I'm down 35% on a tranche I bought all the way back in 2017, and it was a pretty big tranche. So I just got to remain humble. I got to be focused on the long game. And I have to realize that stuff happens. And I think one of the takeaways here is that this could happen on anything I'm buying right now. This could happen on StarBUX, on anything. And I want to remind the community that investing in stocks for dividends, there's an element of risk. And it's a long-term thing. And it's possible to lose money. And I am down on that tranche I bought of PM back in 2017. And so I thought that was kind of breaking news for me because I didn't even remember a lot of this history. I have so many stocks, 46 stocks. I don't remember all the details. And so one of my favorite things about the YouTube channel is it gets me thinking about this stuff and it gives me the perspective, and I got to remain humble. And so what are some other key takeaways from all of this? They increased the dividend. That's great. They are doing 11.2 million adult consumers are enjoying their new IQOS product. I love that product. I think it's the future of the company. Q2 earnings came out. They weren't that good. Adjusted diluted was down 7.5%. However, Q1 was a really big quarter. And so when you combine Q1 and Q2, I highlight it below. They are up on an adjusted diluted basis by 8% year over year. And so that is adjusted diluted EPS. And so that's something worth noting. Now, worth noting as well for Q2 at least, and by the way, what happened with those dynamics? The reason Q1 was so strong is honestly, that's around the time this horrible global pandemic was hitting. And I think a lot of people were stocking up in preparation. They didn't know what the future held. And so they really stocked up on their PM products. And I think when Q2 came around, they didn't need to buy as much. They were still using some of the stock from Q1. And so I bet you that's part of what was happening. But the first 6 months of 2020 have been pretty good to this company. And to think about the fact that adjusted diluted is up 8% year over year. Again, this is a company where their traditional product, it's declining. Check it out on the screen right now. Traditional product is down. Volumes are down in Q2 by 14.5%. But the heated products, the new products like IQOS, were up 24.3%, and that's the future. And so I like the fact this company is pivoting. I like the fact that this old world sleepy company is introducing a new technology, if you will. I like that this company is finding a solution, a better solution for society as well. And so I will continue to hold this company and enjoy the thug life investing that comes with it. Now, what I do want to say is at this time, am I going to add more money to PM? Probably not, because when you add up what I have in PM, in BTI, in MO, when you add up what I have in those, it's a very large dollar amount, and it's also a very large percentage of my portfolio. I got enough of it. And so at this time, I'm not even reinvesting dividends on these. I'm taking the dividends and reinvesting them selectively into other companies. And so for me, am I buying more PM here? No. If I were just getting started out, hypothetically, would I be? Probably, because it's at a better yield than when I first started buying the thing in 2009. And I see a lot of promise with the IQOS product. I really, really do. And so that's the way I look at it. But going back to General Mills, will I be buying General Mills here? Maybe I will, because it's not so big in my portfolio as these SIN stocks are. Could I stand to have a little more General Mills? Hey, why not? It's one of those stocks that I just enjoy it. I think they got good products. Maybe I'll buy a little bit more. We'll see. But all of this gives me good perspective. And so I want to move on to the third segment of the video today, and that's the two stocks that I just purchased within the last week. Check it out on the screen right now. I share all of these trades on Twitter, although I failed to report the first one on Johnson & Johnson. I've been so busy at work that one, I was going to do it, and then I didn't, and then a few days passed, and I'm like, hey, I don't want to post a trade I did a few days ago. I'll just share it in the video. And so anyways, I love sharing this because I bought it at 150 and it's down to 144 now. I want to share this because it happens to me. I see so many of you in my private Facebook group saying, I just bought it. You can thank me for the stock going down. And I want you to know that even I have that happen to me. I have it happen all the time. I buy the stock, it goes down. You know, it can be a little frustrating sometime, but I'm fine. Even at my tranche at 150, I feel that I got good value for my money. I feel J&J is one of it's my number one favorite stock of all time, so I'll buy it at almost any price. But I feel that, hey, it's still reasonable value. But I just want all of you to know at home, you're not alone. If you buy a stock and you feel you bought it at the high water mark, or you bought it and then it went down, it happens to all of us. It happens to all of us. And so it's happened to me so many times, but I'm sure in 20 years from now, I will not care whether I bought at 150 or 144. I will be happy with whatever I bought in good old J&J at these prices. And so I also, and just check out on the screen right now. Let's look at it for a minute. Forward PE right now is an 18 for 2020, 16 for 2021, and that's on the current price of 144, not my purchase price. Payout ratio is pretty good on this stock, not too high, a lot of room to increase the dividend. Anyways, let's move on to StarBUX. Why do I keep buying it? Honestly, I'm starting to wonder if I should keep buying it, because I've been buying this thing in the $50 range, 60s, 70s, and now 80s, and so I bought another tranche on this. Check it out on the screen at 83. PE this year is an 87. PE next year is a 30. I'll tell you why I'm buying it. In reality, I think the PE is not so high as it seems. I think the analysts are wrong. I think it's a case like General Mills where the earnings are going to come out in future quarters and they're going to be amazing, because I see the place so busy. I see it so busy. That being said, why do I keep buying it here? Honestly, it's just because I want to build the position. It's a ride or die stock. It's one of my favorite stocks. It just makes me feel good to have a lot of money in it. It's kind of, maybe you could say there's a little bit of emotion with it. Maybe you could say there's a lot of emotion to it. I got to be honest with myself. That's one of my favorite things about this channel is, and I challenge you at home, be honest with yourself. Don't fool yourself. Don't lie to yourself. if you do something, at least, don't just be honest. And so I'm telling you, I'm buying Starbucks here, and it's not a value, but I'm just kind of buying it because I like buying it. Am I paying a lot of money for it? Yeah. It is what it is. And so that's kind of what it is. But I need to remind myself here, small sizes, Ian, small tranches, brick by brick, because there's probably going to be better value around the corner. And it may not come in Starbucks, but it may come in another stock. There's probably better value around the corner. And so that's what I'm buying. I want to just share another thought before I close out today. I see a lot of dividend investors out there kind of abandon their strategy, going growth stocks, this or that. I wish everyone all the best. One thing that I just take a lot of pride in is my consistency as well. And so one of the reasons I just keep buying Starbucks is it's consistent. I just like to try to buy it every week or almost every week. I used to do it every Mondays. Then I got so busy, did it Tuesday this week. And so consistency is important because there's momentum to it. It's kind of like my videos. My videos have been less frequent. And now that they're less frequent, I find it harder to start back up. Part of it's I'm just working insane hours, and because I'm working insane hours, it makes me appreciate dividends even more because they're truly passive. The most passive thing you can do, most passive investment there is, in my humble opinion. But it's just kind of the consistency. It's like, hey, I'm doing fewer videos, and then it's harder to rebuild the momentum. But it's like with Starbucks, I got so much momentum, I just kind of keep it up. There's something to be said for that. There's something to be said to just buying because you have the momentum and you're in the habit versus trying to worry too much about the price you're paying, especially if you have a long-term time horizon. Now, that contradicts exactly what I was saying when I started the video, General Mills. But again, dividend investing, it is filled with paradoxes. Everyone, thank you for hanging in there at the video today. Please give me a thumbs up, a like, comment, subscription. All of that means the world to me. It's the best way you can thank me for these videos. I am actually actively trying to rebuild my momentum here because these videos make me so happy. It is so much fun to do this. It's so much fun to engage with all of you in the comments below or on the Facebook group, just on the internet, throughout social media. I love this stuff, and it makes me happy to see the passive income come in, especially when I'm working so actively right now. And I got to just build up my momentum and get back in the habit. And so share your love in the comments below, your support. It helps me build my momentum even quicker. Much love to all the patrons out there on Patreon who have stood by me even when I've been doing decreased frequency of videos. Thank you to all of my homies over there. It means the world to me. Before I leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long General Mills, ticker symbol GIS. Shout out. I am long Philip Morris, ticker symbol PM. I am long Altria, ticker symbol MO, and I am long BTI, ticker symbol BTI. I own all of them in my personal stock portfolio, Thug Life. In terms of a friendly disclaimer, I'm going to edit this tonight and get this live tonight, by the way. I know people have been waiting. I'm just going to do it. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for your fun and entertainment. Investing in the stock market, especially right now in these crazy times, carries quite a bit of risk. Thanks to everyone, too, who's supporting me through the merch. Love you all. I'll see you in the comments below, and I'll see you in the next video.